Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Yesterday's sharp sell-off on Wall Street has investors rushing to safer assets like treasuries, pushing yields a bit lower. Even so, credit fundamentals remain solid with tighter spreads and strong demand for yield. At the same time, our next guest notes that we're also seeing growing dispersion and some early signs of stress in parts of the loan market. So what's really driving this push and pull in credit right now, and where should investors be looking if conditions become more volatile? Joining us here today to break it all down is fixed income portfolio manager Peter Kahn. Welcome. Great to see you, Peter.
Nice to be here, Pamela. Thanks for having me.
Delighted to have you here. It's Friday. Happy Friday to everyone. Do send questions in for Peter over the next 30 minutes or so. Let's begin with data centers. What's funding them? Lots of debt being demanded at this point. We just look to you for your moment in the markets here right now because we've got you seated here and you're a trader. You're trading this stuff. What's going on out there?
Well, it's a good time to be a trader because there's a lot of volatility in the markets at the moment. So there's also a lot of uncertainty about how many of these data center models are going to be required in 3, 5, or 10 years' time. But the projections at the moment are just astronomical, as you well know, Pamela, about the degree of capital expenditure that's going to be required for the hyperscalers et al. To achieve their dreams. We're talking trillions of dollars over the course of the next few years. And, it's not so easy to find trillions of dollars in one place only. So sponsors and companies have been assiduously courting investors, for a few months now, but really
all kinds of investors
in style, in investment grade credit, asset-backed credit, high yield credit, private credit. All of these channels need to be, for lack of a better term, exploited. I mean, I kind of want to say used and abused by those who are trying to achieve the build out. And we've seen a lot of activity in every corner of the market, particularly in the last couple of months.
Tell us about that. Like, there's a really big one out there that would it have caught you off guard even? I mean, this is what you do every day and have for your career, but it was a big bond sale.
For sure. What you're referring to is obviously the Beignet, hope I said that right.
Yeah, I did too, because I couldn't correct you. Yeah.
Finance deal that was, it's a JV from Meta and Blue Owl, which is a large private credit investor. And it was cheekily named because the data centers are based in Louisiana, so a reference to the famous Café du Monde down in New Orleans. And they certainly offered quite a sugar rush to investors because what came was a $27 billion investment grade deal, so one of the largest single tranche investment grade deals that we've seen in history, not just this year. And, very uncharacteristically, it went up 10 points. Right, that's not your garden variety performance for even a high yield bond or maybe even an equity IPO to register 10% on a day. That's maybe a little bit more mundane, but this sort of thing never happens in investment grade credit. So why did they leave so much value on the table for investors? Well, that's because 27 billion is a drop in the bucket relative to the financing needs.
Okay. And is there anything that you would point out to everyone that is slightly different in the structure? I mean, we're hearing a lot about the circular financing that's going on right now. There are lots of different pieces that are a little bit just slightly different financing that's going on. Anything to either worry about, note from your perspective? You look at this all day. Some people are saying, the hyperscalers want to go ahead and use their free cash flow for this and don't want to use debt, but they're finding kind of some other creative ways to make that happen. What would you point to that's interesting about the structure of some of these deals?
Yeah, that's a great question. And they do have a lot of cash that they've been accumulating over the last decade plus that they can decide to contribute to the overall investment need, but
rather than debt.
But clearly, again, scale is required here, so the cash alone won't do it. Secondly, clearly they wouldn't necessarily want to put all of their eggs literally in that one basket and continue to have flexibility to fund share repurchases, dividends, other needs, not to mention rainy day funds.
Sure.
And doing things with other people's money is what the financial market has learned, how to do, particularly if you need to do it in size over the course of the last 20 and 30 years, right? As long as there's adequate security and compensation, we're willing to, at least consider a number of those proposals. But, the kind of model that's coming in now to back some of the data center build-outs, it's not homogenous, right? So we've seen a few deals in the high yield market since the midsummer that have come in either with a large hyperscaler backstop on a kind of speculative shell that is building out the data center on their behalf. So
like a SPAC.
It's not necessarily like a SPAC, but more of a financial guarantor. Kind of like a bank of mom and dad sort of model. Sending this venture out to build something on their behalf. That needs a lot of investment and a lot of time and critical parts in order to be constructed and created, but saying like, I'm there, don't worry, I'm the fallback.
Sure.
So that's clearly, as credit investors, wanting something firm to hold on to more so than a promise or a pledge of shares. That's going to have a greater attraction than deals that are based on, let's say, flimsier guarantees.
Okay, so it's fascinating. So it's an interesting, is there a little bit of a, air pockets, maybe not the right word, but the idea of displacing water on some level when you have deals this size in the market? I'm just kind of curious how you see possibly a good ripple effect, but we are seeing a lot of equity market volatility. The question has to be asked of whether the ripples are not a good effect, that this is changing the market in a difficult moment for it to digest it. It feels like it's hard for the market to digest some of these stories.
That's an interesting observation, and it's true, right? Displacement. I mean, we don't necessarily think of things as a zero-sum game when we're considering any individual investment in the fund, but you do want to think about things as alternatives or substitutes, or where's the best use of capital, where's the opportunity cost, and there will be I wouldn't necessarily say we're achieving any sort of critical mass such that there's a limitation on the available investment.
That's
why
good to know.
Why do I say that? Because the overall, it's difficult to prove, but the overall sensation is that credit as an asset class may be under-owned by large global institutional investors. Part of that can just be sort of tacit, right? Equity markets have done so well that their relative weight in equities has risen, so they may need to top it up. There's a lot of liquidity available in the overall system, which we've talked about before, driven by Fed and other central banks. And the other item to think about there is that there's it's simple sort of relative value game. So in the high yield cases in particular that I referred to earlier, you're talking about instruments that are going to be rated, say, low double B.
Sure.
Right. So a little bit of default risk, not too much default risk. Your bog standard double B for like a consumer products company or a packaging company or utility trades around 5%, 5.25%, 5.5%, right, for a 5-year bond. The kind of return on offer in these data center deals originally was 7.5. It's come into maybe 6.75 over the last couple of weeks, but that's still 150 basis points excess premium, which is nothing to sneeze at in our space. So you have to consider it.
Well, in your space, okay. So let's talk about the high yield market. When we've spoken over the course of every sort of 2 or 3 months, have a conversation. The fund itself, taking a look at some of the opportunities that you were using there. The yield was up to what was higher than sort of 7-8%, was it not?
It was, and kind of as we went through the summer and conditions were perfect in every sense of the word, we saw the yield on the market come all the way down to about 6.5, 6 5/8.
Okay. Yeah.
The little bout of volatility, and let's not overlook the macro factors here, not least kind of the market's continual sort of wrestling with the idea of the Fed's going to cut a lot.
Yes.
Or the Fed can't cut a lot, right? And we've talked about that dynamic in the past. And
this week has provided another one of those.
Correct. So
moments.
the pendulum is swinging back to the Fed is kind of boxed in.
Right.
They can make some micro adjustments to rates here, but by no means are they going to be slashing them by more than 1% over the next 12 months. So
the market story in equities is obviously AI. The market story in high yields is also AI. I mean, is that what you're looking at right now? You mentioned consumer packaging. That doesn't sound like AI. What are you invested in?
So that's the beauty of the high yield market, particularly the U.S. high yield market, because it's kind of deep and broad with a lot of sectoral diversification.
Okay.
So we're not necessarily dominated by any one sector. The largest sector in our space is still energy, which is about 12% of the market. And then it kind of falls down from there. Technology, low to mid single digits. It's there, it's real. You mentioned the ripple effect and positive ripples and negative ripples. The negative ripples are clearly related to the extreme tightness of correlation across asset classes right now. So
that's we have to pick that apart a little bit, because people worry about a 2022-like moment where sort of everything went down together. So I have to ask you that. That is it's something that you're marking.
It's a significant risk.
It's a secret.
We had some interesting conversations within our global fixed income team over the course of this week, and one of, I think, the best observations that was actually made by one of our emerging markets portfolio managers, who shared around a chart of the correlation between emerging market fixed income returns and the S&P. And the correlation there has never been tighter. So there is deep concern that with so much of the S&P's returns driven by the Mag 7. The rest of the equity universe is clearly not having a bad earnings season. Things are improving, but it's basically the rich getting richer and everybody else being left to scrap over the crumbs.
It's very EM.
It's very EM. And we could, of course, you're going to tempt me to digress into how many things are very EM now, south of the border here in terms of the behavior of
now that you mentioned
the government.
Yes. Well, I mean, that's what commentators will say, right? That there's a structure politically, but also a little bit in the markets. I guess, just through your lens, is that interesting? Does that make you want to diversify away from the United States for that very reason? Is there currency risk? Do comment a little bit on that.
Yeah, that's for sure on the top of our mind, and we want to, in general, right, when correlations are tight, we want to be more diversified, because it's very difficult to call when things will, inflect from one day to another, and having too much concentration in one particular space is an issue in general. In the U.S., the great debate is not that things are going to go from feast to famine overnight, but it's clearly things are turning, things are changing, conditions are evolving. We're entering into a different world with a more robust industrial policy that's being actively managed out of the executive branch, with the central bank. We've talked quite a lot.
And the government itself, the structures of government itself, all being managed a little bit more by the administration than in the past.
Managed more by the administration in the past, and critical ones from a market perspective being, debased, to an extent. And of course, your question really gets at, debasement of the dollar, and how big of a problem is this for the world. And
because it's not for the administration. I mean, as we understand it, it's one of the goals to help with the debt burden that they're dealing with. But that is a story that, as an investor sitting in Canada or anywhere around the world, is not necessarily one that you want to help with, or do you? I guess.
Well, I mean, the entire sort of G7 system plus China is weighted down with excess debt, excess deficit, and one of the classical mechanisms to manage your way out of that would be simply to inflate your way out of that. And regardless of the details of what's being implemented, in the U.S. and elsewhere, that seems to be, the pure fact on the ground is that there is some desire to reflate in order to make the debt problem go away,
or at least eat away at it. Yeah.
Exactly. So the question is it's always a matter of a rate of change. In markets, as you know. So if things happen in a disruptive and disorderly fashion, that's bad. That can switch off the spigots and slow down financing. And at the end of the day, right, our economic model in Canada and in the U.S. and in the rest of the Western world is very credit driven. And we saw what the experiences were with like an extended shutdown of the credit mechanism in the financial crisis, and with temporary shutdowns of the credit mechanism with things like COVID and Russia, Ukraine.
It funds the joint.
Correct.
You don't want it to come to a halt or to shut down. That said, as a trader, you take a look at high yielding bonds, as a matter of course. That means on some level, you rush towards danger. When there's a moment to invest and others are fleeing, you walk in fearlessly. We understand. But I mean, what opportunities are out there? Because there's real vol out there, and there's concern that there's more to come.
Yes.
Whether there is or there isn't, the expectations are there.
Well, I mean, that's a great point, and we try to be as fearless as we can, but sometimes we go in with knees knocking or whatnot. Yeah. But it helps to have kind of done your homework before, right? So that's the benefit of Fidelity and its global network of research expertise and risk management expertise. So we can bounce ideas off of one another in the fixed income team. We can speak to our equity colleagues.
You have eyes all over the world.
Exactly, and exchange of information, feedback, exchange of ideas. Thinking through how we can do this, all predicated upon the bottom-up, fundamental research that is done by the equity and credit research teams that can help us focus and try to shut out some of the noise in these situations. And as active managers or as traders, whatever the term you might want to use, but as active portfolio managers, right, we do relish these opportunities when volatility picks up and gives us, a chance to really focus on the opportunities that we haven't been able to participate in yet because we've had some kind of objection, whether that's related to
valuation,
the value on offer before, or we didn't have enough information yet, but we've continued to try to peel away the layers of the onion and get at what really drives a particular business or what might make a credit perform or not perform. And so that's an excellent opportunity for us in general.
So I was going to just add to that. What sort of information is given to you in market drawdowns? Now, that said, you anticipate a lot. The team of analysts that you just referenced are there before events happen to sort of, on some level, know what would happen in X situation. But that said, you must gain some data, some information from wobbles in markets. I mean, it gives you data about a company and how it does, for instance.
Yes.
What do you gain from moments of volatility that beyond just the pure investment of just sort of learning about how the structure is either strong or weak in certain areas?
That's one for sure. I mean, Dick Cheney passed away. Lots of people have things to say about that. Yeah. And he and his neocon friends, they always used to focus on, known unknowns and unknown unknowns.
They did. That's right. I used to hear about that.
And I guess the most important thing to know heading into all this is to appreciate what you don't know and what you can't know.
Okay.
So that's
embrace the mystery.
that's one thing. Yeah. But what you do find out is, you expected A to happen, and then B happened, right? And sometimes that's for the better, and sometimes it's not. So for us as credit investors, being glass half empty, of course, all the time, we
more pessimistic
we tend to, we try not to be, but we tend to try to then isolate and say, okay, we thought this particular sector or story was going to be a lot more resilient in the event of a downturn. Or we didn't expect it to move that much, right?
Yeah. Okay.
In the best case scenario, we don't own it, and it's really moved a lot to dramatically change the risk reward proposition.
Right.
And in the worst scenario, we do own it, and we've clearly missed something that the market is homing in on or focused upon, and we need to ascertain pretty quickly, is that something from the bottom up that we haven't been appreciating the risk factor correctly, or is it some related but macro force, like almost is it a force majeure type of event, like there's just a market liquidity factor.
You have, as we just said, a team around the world to figure that out faster than
Correct.
Most other people who don't have teams around them.
Yes.
to figure out very quickly what the action needs to be, for instance.
Absolutely. And then we can take that action and implement it as quickly as the markets will allow us to, right? And there's a bit of art and science to that when it comes to credit trading.
It's fascinating. So in the moment you are hearing anecdotally that some obviously love being in equity markets. Has been an incredible time. There are obviously these concerns. We'll hear from some of your colleagues like Shritella that you'll see some equity investors taking some chips off the table, going to book it into the fixed income side of their portfolio a bit more.
Yeah.
You see some of that. Is there an argument that if you want to take some risk and you're the right person, you've done all the information, you've spoken with your advisor, that you could have high yield as your equity exposure or as your risk exposure within a portfolio instead of? Does that question get asked or tossed around?
Yeah, it does get asked, and we often, from institutional investors to individual investors, that consideration as to whether or not a growth-like asset can be found that doesn't have all of the kind of volatility characteristics of equities,
right.
Whether large cap, mid cap, small cap, whichever flavor is their preference.
And private credit is one way of doing that, but this also is a little more visibility.
Visibility and liquidity.
Quality.
Transparency and governance, have clearly been in focus when it comes to what's been going on in the private credit market and the broader leveraged finance markets over the course of the last 2 months, in particular. And Jamie Dimon, bless him, he's likely right that where there's one,
this is the cockroach
there will be another, because the kind of environment that we've been in with easy liquidity, easy financial conditions, sort of a seller's market when it comes to raising debt, is one that historically has proven to generate some malfeasance. And
so let's go into the moment for high yield debt at this moment, because it sounds like it's a really interesting opportunity for those that would like a very nice yield.
Yes.
In many cases, but again, just higher in the pecking order. So what is this moment for high yield debt for investors?
Yeah. Well, it's a very interesting opportunity, right? Still, right? We talked about it before, earlier in the summer, 7% yield, low duration, reasonably low volatility. Here we are still, we've traveled all the way to 6.5, we've backed up to 7% yield, reasonable credit quality at the overall, aggregate market level. So taking a diversified approach to capture that income stream in an environment when risk-free rates have fallen and volatility is rising, in other asset classes, is not the worst place to park and earn a pretty happy and healthy risk-adjusted return on your allocation.
It's fascinating. There's a question coming in that has to do with the correlations that we were talking about a little bit before. So equities in the U.S. tend to be correlated with EFI. Does the same apply to U.S. versus global credit? Oh, okay. Interesting.
That's a very good question. So the U.S. credit market is the largest one, particularly if you get into my little corner of the world in high yield. So,
how big is that market?
Overall, the U.S. high yield market is about 1.4 trillion. The European high yield market is the next largest, and that's roughly 450 billion. So U.S.
globally, do you get to sort of 2 and something?
You get to 2 and something. That's right. So the tail doesn't necessarily always wag the dog, but you can see significant divergence depending upon regional qualities and characteristics. So between Asia, which has clearly been very China dominated, and particularly China property dominated, behaved in a very isolated and idiosyncratic manner for a long time, but things have caught up there as the market has naturally cleansed itself with, that's kind of cleansing by fire. Cleansing by default is what we see in the high yield market. So as things sort of fall off, you're left with a residual that's more resilient. And then when that happens, things tend to trade a little bit more together because you're not asking that question about like, what is it specifically about this sector or these big companies in that space that is very different from the rest of the world. So at the moment, we're kind of in that space where correlations are a little bit higher, but European high yield has been doing its own thing because the composition of that market is rather different. It's more double B heavy, but it's also got a tail of triple C assets that's a lot more concentrated than triple C in U.S. high yield.
Because they haven't moved up and cleaned themselves up enough?
Well, Europe is still very much a bank-dominated financing model, right? So the corporate finance split is more heavily skewed to use of banks and private credit in Europe, particularly for smaller companies that are not, so accustomed to dealing with the demands of public side investors, and who simply don't want to. And it is demands, right? And it's if you've been running a family business for several generations, and all of a sudden some sharp-elbowed public investor starts asking you questions that you're not comfortable answering, it's much easier to go to your banker.
Yeah. Oh, that's so interesting. And you spent quite a lot of time in London on the European debt side of things.
Yes.
Yeah. So this is an area that you know well. Tell us a little bit about the fund, what investors take a look at when they dive into high yield fund on offer.
So, the first thing to think about is, what's the overall appetite for credit risk? Are you, looking for outperformance of credit, or are you taking a more measured approach? The fund management universe over the course of the last year has been taking a fairly measured approach, and we wouldn't necessarily say we're significantly different from them in that overall sort of risk appetite.
Okay.
And that's informed by the fact that we want to focus on generating investors solid returns over a longer horizon. So we're not thinking, we of course are thinking and managing on a day-to-day basis, but we really want to be able to generate consistent long-term returns for investors. And one of the best ways to do that in high yield is not necessarily by chasing the latest and greatest thing. You want to have a little bit of that, but you don't want to be overly concentrated in too many go-go names, because really what generates returns for investors in our space is avoidance of the stuff that blows up.
Right,
So we're not, the equity market things don't necessarily always go to zero if they go totally wrong in our space, but we do have the asymmetric risk problem of the payoff profile in our space. So it makes sense to choose selectively.
Let me ask you as a final question, how does investing in high yield help you stay invested, not hit the sell button?
It helps you move up the capital structure, if you will. So out of that thing that's out there on the ledge or close to the ledge, that it may go up 100%, but it may also go to zero, while taking advantage of the fact that our space within fixed income, right? The next thing people worry about when they want to buy fixed income is what's going to happen to yields, or their bonds going to go up, down, whatever. Is that going to destroy my returns, which is what we saw in 2022 with the beginning of the Fed's hiking cycle. A lot of returns were destroyed in long duration fixed income. High yield is a shorter duration asset class.
Right.
The income stream really protects investors quite a lot over time. The underlying quality of our market has continued to improve and evolve significantly over the last 10 years, so the inherent default risk is lower. So what's your forward return expectation on equity markets? That's not my bailiwick, but reading the sell side pieces that are coming out for 2026 outlook in the next 10 years, people are talking about projected equity returns in the US of, surprise, 7 to 8%. Right? So
there you go. So
you want 7% and 20% vol, or do you want 7% and 6-7% vol?
Ooh, we're going to leave it on that. That's brilliant. Peter Kahn, for Friday, you've given us a lot to think about going into the weekend. Thank you for joining us here today.
Pleasure to be here.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Well, on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.